Hello, this is High Quality Potato. Today, we are going to learn about a very special magic, hidden in the stock market, Shannon's Demon. This demon is also the protagonist of the legendary story that earned 100 billion won with just $1. By the way, did you know that the hot AI chatbot, Claude, was named after Shannon? What could the true identity of this demon be? To understand Shannon's Demon, we first need to meet its main character, Claude Shannon. He was a genius mathematician and engineer known as the father of information theory. Shannon, considered one of the greatest geniuses of the 20th century, also demonstrated his brilliance in the stock market. He found a way to beat the market using only simple mathematical principles, without complex predictions or analyses. This is the Shannon's Demon strategy. Shannon's Demon takes the familiar concept of diversified investment to the next level. Generally, diversified investment means spreading your investments across multiple assets. Much like the saying, don't put all your eggs in one basket. However, Shannon's strategy does not stop here. He suggested maintaining a 50-50 ratio between two assets, such as stocks and cash. While explaining his strategy, Shannon used principles similar to the Kelly Criterion. The Kelly formula is a mathematical formula used to calculate the optimal betting amount to increase the odds of winning in gambling. Shannon applied this formula to investing, discovering a method to automatically maximize profits by maintaining a constant asset ratio in any situation. Regardless of whether the market goes up or down, the key is to readjust the assets every time the ratio is broken. The biggest advantage of this strategy is risk management. We usually feel happy when the market goes up and anxious when it goes down. However, Shannon's Demon is not swayed by emotions. This is because when the market rises, profits are realized, and when the market falls, purchases are made at lower prices. It's like a demon secretly coming to sell at high prices and casting a spell to buy at low prices. Through this process, investors can steadily grow their assets even amidst significant volatility. So how can we apply this strategy to actual investments? The best example is to invest 50% in stock ETFs and 50% in bond ETFs. If the market rises and the proportion of stocks reaches 60%, we sell the excess 10% of stocks and invest in bonds. Conversely, if the market falls and the stock ratio becomes 40%, we sell bonds to buy stocks to fill the 10% gap. By periodically rebalancing in this way, we can pursue stable returns regardless of market trends. In fact, we can verify the effects through simulations. The graph you see here shows the results of investing $1, with one side investing only in highly volatile stocks and the other side maintaining a 50-50 balance between stocks and cash, followed by rebalancing. The blue line represents the results of investing only in stocks, which fluctuated without showing significant growth. On the other hand, the orange line represents the results of a portfolio following the Shannon's Goblin strategy. You can see that it steadily and stably trends upward, ultimately achieving much greater returns than if you had only invested in stocks. This graph proves that principles can work the magic of investing, rather than mere predictions. Today, we explored an amazing investment strategy, Shannon's Goblin, that can beat the market without complex predictions. I hope this magical strategy, which turns market volatility into an opportunity, will greatly assist your investments. Next time, we will take a closer look at the Kelly Criterion that I briefly mentioned today. Let's explore together how much smarter your betting can become through this formula. Don't forget to subscribe, like, and set notifications. Thank you.